Folks, at One Rental at a Time, we are truly blessed, truly honored to have the man known as Housing, Lance Lambert, come back each week. How you doing, sir?
Zuber, thank you for having me on. And like you said, housing, and there is always so much going
Yeah.
on.
One of the things that I wanted to do today with you, if you don't mind, is I actually want to step back. I think there's a lot of chatter in housing, frankly, from non-professionals, from posers, from from charlatans, from idiots, from clowns, who expect housing to move like stocks or even worse, crypto. So what I want to do is go back in the time machine, pull up the 53-year spreadsheet, which you and I've looked at, which I consider very stale and very macro. And I just want to remind people how slowly housing moves. What do you think about all that?
I love that. And, we've been in this window where we've had a couple of really abrupt shifts in the big picture economy have happened over the past 3 years that have made housing move in a way that's much faster than normal. So what
Correct.
we are in now is the normal of history of housing. It moves slow. And you never really take one reading with too much of a grain of salt because it moves so slow that usually those end up being the outliers. A reading that goes a little high or a little too low in 1 month. So I love this. Let's zoom back out and look at the historical housing market of the past.
Awesome. So let's bring up the spreadsheet again, folks. You can go to onerentalatatime.com, the lower right box, put your email. You can get this spreadsheet. If you haven't seen this before, we'll just really quickly highlight all the data sources are linked. You can see St. Louis Fed, all of these things. Again, these are not my data. It's from
I
the
want to give you
it's,
some more data in this. So let me put this on my calendar. Go back to your main sheet before we get into it.
yep.
I could get you the historical on Freddie Mac prices.
Oh, that'd be great.
I think that would be a good one. Maybe the Case Shiller historical one. And then what's the one that FHFA?
FHFA. Yep.
We could go back to the 70s on that one too.
That would be
Um,
awesome.
I think they pretty much go to where yours starts, but I think that might be helpful to kind of see
Yeah, I
those.
mean, any data that you could give to round this out would be wonderful. And when we zoom out, again, trying to relate today to a similar time in the past, I always go to like 1978. And the reason I go to 1978 is that's when inflation was raging. Again, inflation is down here somewhere. CPI inflation in 78 was 7%. But look what happened in 79. And again, I'll just highlight these rows for folks just so it's easier to see. How would I do that? I go like this. Let's make this yellow. Sorry, folks. We're doing this in real time. So again, 1978 inflation CPI was 7.6. It jumps to over 11 in 79. That's why I go here first. Because what happened to us is inflation went from nothing to 9. So this is just a similar environment to us.
Yeah. I think the good one, the a little bit better is probably skipping ahead a little more.
Okay.
79 to 80 would kind of
Okay.
be like, 2022. Go back,
Okay.
79. So do the highlight of the existing home sales, the row six.
Yep. That's where we're going to next. You're absolutely right.
Okay. So there you see it. That's the crash in resale transactions. And really, it was felt more acutely too in the new home building sector, which is a little bit of the different story here. But yeah, existing home sales, oh my gosh, 3.8 million to 1.9 by 1982. And yeah, just a huge hit. And what happened there is that housing affordability got absolutely cooked with mortgage rates and Paul Volcker, really slamming down his fist. I mean, boy, look at
Yeah.
that drop. Now, 83 is a nice drop bounce off the bottom, but it was a misleading recovery it,
Correct.
because then it really slowed down.
Mm-hmm.
Yeah.
Yeah. So 19, this is another thing I just want people to realize. Everybody's acting like today's the worst affordability ever. It is not. It's not even close. 1981 is the worst affordability on record. And a lot of people don't realize.
Now, what I do think is important to look at is the fact home prices here, they didn't really move down nationally, kept moving up. Now
Yeah,
there
look
was
at that.
big acceleration, the growth rate kind of slowed, you know, and not much was moving for a bit.
Hmm.
Now that's interesting. See, I think that this median price
Hmm.
gets swayed a little more. Like, I don't think that the resale indices have house prices up as much. I'd have to take a look at those. So,
Yeah, well, that'll be a good thing by adding Case Shiller, FHA.
yeah, Freddie Mac to
Yeah,
get,
yeah, get the spread. Yeah,
yeah,
I don't know what the source is for eight. We'll find out. Because I report everything. Existing
yeah.
home sales. So this is where it's coming from. I just transcribed the numbers, Fred St. Louis. So just so you know where these come from, it's December 31st number, right? So I had to pick a date every year. That's where the number comes
Can
from,
you scroll all the way to present?
all the way to present. Oh, sure. Well, yeah, we haven't done 2023 data yet, but yes. Well,
Yeah.
the
Now,
last year
see,
we
yeah,
have historical.
using these, you're going to end up down a lot more on prices because those medians that you're using, and they're getting moved by that mix shift.
Correct. Yeah, again,
Yeah.
this is why I want to go back in time and also realize that housing is this big machine because you highlighted something today or yesterday. I read it this morning in Resi Club called Shrinkflation, which really explains, and now it's new homes, but just that idea that housing will change as affordability gets worse. Guess what? Builders build smaller homes. I mean,
You know, if we add a few more rows into this, we could build a forecast model out of this.
that would be fun.
Yeah. Now, it would probably be better to have the monthly data, but I mean, it's a close start where you're hitting on so many of the core metrics that pull into those. You could pretty much do it. I love this data set.
Yeah. So I like to do it at the yearly level because again, most people that watch us, Lance, aren't in the weeds like you and I are. So we've got to keep it up a level. But yeah, I mean, I'm game to beat this up and add more value. So sign me up. Put me in, coach. But back to the story. So 79, 3.8. Paul Volcker comes in and jacks rates up. Where is the interest rate? Here it is. 30-year interest rate goes from 11 to 13 to 16. So rates go up a lot, right? Up 500 basis points from 1979. So that seems like kind of familiar, right? We kind of like something else we did recently.
Yeah. Exactly. Could you scroll? Do you have 2022 in there?
Yes, 22 I have. Yes.
Yeah, I want to see the difference between affordability. Well, see, 22 would still be a little better if it's the whole year. Are these end of year numbers or are these like an average for the full year?
No, just end of year. I picked a date because the
Okay,
data is reported. So I picked the last date to be consistent.
got it. Okay. Where's the affordability?
Affordability, housing affordability is row 16.
Yeah. And that's what's unique about this one is that move right there, that 21 to 2022, according to the analysis I've seen, while this isn't the most unaffordable market, that late 22 move was the fastest ever deterioration in affordability.
That is absolutely true.
Very fast. So that 80s one, affordability got hit harder, but it was a
Right. But
little slower. But
it's
going
because of the average, right? We go from 11 to 16 versus going from 1 to 5. It's a percentage game. Yeah.
Yeah. And the difference between an 11% mortgage rate and a 15, 16, I believe isn't as much as going from a
Correct.
2 to a 7 math wise in
No,
terms of,
absolutely correct. You go up 300% in one, and the other one, you're going up 50%. You're
yeah.
absolutely correct.
Yeah. So the affordability hit was just so hard. And the reason being is because in COVID, they went to max low interest rates. They went
Yeah.
all the way to the bottom.
They
And
were
then
buying,
boom.
the government was buying like 40% of all mortgages. It was
Yeah.
bananas.
So that affordability shift was just a real big gut punch. And you look at the housing market last year, the mortgage rate got to 8%.
Correct.
Prices, I mean, yeah, the end of last year was a little softer, but they weren't falling. We still ended up year over year for prices.
Correct.
Now, the reason we got destabilized at the end of 2022 was how quick the deterioration occurred.
Exactly.
It
Speed.
knocked
Yes.
it knocked the housing market dizzy for a little bit, and then it it bounced back. But it was interesting to kind of see it happen in real time, to see 6 months destabilization like that.
Yeah. And the big thing for me, why I always go back to this spreadsheet, because everybody is talking about how fast things move. Just look at this. 1978, as you called out, we did 3.8 million sales existing. Just look at how long it took for us to get back to 3.8. And keep in mind, the population is growing all of this time.
Yeah. And so this is, in my view, and I think we have a shared view here, is a lot of that is switching cost, which is
Correct.
a lot of folks who have a lower mortgage rate. Let's say you have a 3% mortgage rate.
Mhm.
When mortgage rates shoot up to 7, and you would be trading in that, I don't know, $1,800 a month payment for
Yep.
something that's like $3,200 a month, that
Yeah.
switching cost is huge. The switching
It,
cost on a numerical basis is, like in that example, like $1,500, right?
yeah, it's even worse than that. So switching costs is absolutely the right economic variable, but you got to realize there's a mortgage lender inserted in there. And some folks, Lance, won't even get the option to switch. They will get a no answer from the bank.
Yeah, exactly. They're not even eligible.
They're not, demand is two steps, willingness and ability. You might
Yes.
be willing to move, but if the bank says no, you don't count as demand.
And so that first part is the raw hit to switching cost, which in my view is felt most acutely right out of the gate, which is probably
Correct.
why you look at 81 and 82, the sales just tanked, right?
Greater.
Now,
Yes.
over time, as mortgage rates improved, that switching cost came down a bit, but it was still there. So
Yeah.
what really had to happen, and this was a drawn out process, is that the psychological parts of switching costs, having more,
Correct.
maybe one of the people in the relationship gets a job relocation. There's these other things that affect the switching costs that are psychological and relationship and lifestyle, but they take time. They don't play out
Duration.
right away.
Time.
And
Correct.
and so over time, I think heading forward, some of the people with 2, 3, 4% mortgage rates, they're going to move, they're going to sell, they're going to move on with their life. Although some of them are going to want to keep them as rentals, and they're going to listen to
That's
your
the
channel,
other point.
get
Exactly.
landlords. But some of these people will eventually move, but it's a
Correct.
process. And even now, we've seen new listings bounce off of that bottom, but we're
Mhm.
not raging back. Like,
No.
you have to almost take my charts and zoom in to see the
Yeah. It's a little bit higher.
yeah. And so what I call the lock-in effect, which is essentially the fact that new listings have fallen off so much, it's really a switching cost, but it takes time to heal.
Well, the other thing I want to dismiss in the myth is a lot of people for a long time have said price follows volume. As volume goes up, prices go up. As volume goes down, prices go down. And while that might work in crypto and that might work in stocks, it doesn't work in housing. It's that one-to-one relationship is not there. It doesn't exist. I mean,
Yeah,
just look at this. Yeah.
I think the problem with the rule is I don't know where they got the rule.
I
I
don't
don't
know where they got it either.
because they didn't get it from here
Yeah.
in the 80s. They didn't get it from the 70s. I don't know if they took the GFC and were like,
Yep.
oh, it happened there.
Oh, you
But
let's go look at the GFC because you and I
will
have
I?
just
Now on now I'd had to see what the existing home sales are, but mortgage purchase applications, they bottomed actually in 14. But yeah, the existing home sales did the okay, so the ex,
see. Yeah, so they bought them like in
they
10.
like pulled the rule from here because prices bottomed in 12. But the thing here is, do you have active listings?
I don't. Sorry.
The problem with the rule is, yeah, it might be true if you have a huge supply glut, right? But
Exactly.
yeah, and so if this housing cycle has played out, right, this rollover, the
Mhm.
mortgage rate shock, this downturn, whatever you want to call this, then what would have been the case is prices would have bottomed in January 2023,
Mhm.
and existing sales would have bottomed in like December 2000. So
Yeah,
11
probably.
months.
Yep.
So this cycle, if it is played out, you would have had 6 months of prices falling, but you really had like 15, 16 months of the existing sales moving down and not bottoming to the end of 2023. Of course, it's hard in the immediate term to be certain if a cycle has played out. There could, if mortgage rates somehow got up to 8.5% next month, something crazy happened. Existing home sales probably haven't bottomed on a seasonally adjusted basis because affordability is really a huge key to finding out when the existing side of the market bottoms.
Yeah. The other thing that, again, I wish people would realize is anytime I hear someone talk about the median home price in the United States falling more than 10% in a single year, I lose my mind. I just lose it. In the Great Recession, the worst year ever, according to these numbers, was down 6%. That's when single family homes were the assets being destroyed.
Yeah.
Median price doesn't move at a
So
national level.
yours is big. The biggest is 6. I think the repeats have 8 is
It's 8,
2008 is
the
like
lowest,
8
I
to
think.
12 is a range. But I
Yeah.
mean, that's because 2008 was just, I mean, you
Yeah.
were there in the real world.
I was. It was,
I
yeah.
mean, there were actual regional markets within, I mean, what could have been
My
like
mark.
20% in some of these.
Oh, no.
Like,
I mean, yeah, if you want to talk about a buy box going down 10 or 20%, no problem. But if you're going to come back and tell me the median home price for the United States is going to fall double digits in a year, I laugh in your face. Now, if you want to tell me it falls double digits over a cycle, we can have that conversation.
yeah,
But there's just so much data in here that just says these calls by these clowns and charlatans, these doomers, the numbers don't support most of their wild ass calls.
yeah. I think the best if they were going to get to a scenario where we had a good a rollover more in prices,
Mm-hmm.
um, they they probably need the cycle to run more, prices to run up more, some type of distress to move into the market, and they need actives to move up.
Well, let's
So
play this out. Let's play out. Let me give you the how I think you get double digit median home price declines. And I think it's a collection of things. Rates have to go higher. Unemployment has to go higher and stay higher. I'm talking 8, 9, 10% for over a year. And the reason I say that is, and again, I lived 08. I was in the teeth of that. Banks acted fundamentally different. If we
yeah,
started seeing residential homes crisis, do you know what they would do today, Lance? They would have forbearance up in a minute,
yeah.
just like they did last. It's just a fundamentally different structure.
Well,
You
yeah, and so I don't even think it's just unemployment moves there. Now, that would be a key if you were trying to like concoct it. I think an important part though is you might need prices to get moving even higher, more.
even
Yeah.
higher, exactly. You need a
And
farther run up. Yep,
you need to have more vintages,
yep,
more years
exactly.
of people really stretching themselves. And
That's
then
exactly what happened last time. It was year after
that's
year after year. Yep.
the problem here is even if we had had a recession, 2020, 2021, and the first half of 2022, these are some really great vintages. In
Dude,
terms of
yeah,
like,
their mortgage payments are less than rent. They're not
yeah.
going anywhere.
Now you start looking at 2023, it gets a
That's
little,
different. Yeah, a little different.
you
But it's
probably,
not long enough.
but I
Not
will
enough time.
say one thing that's different here is last time those their worst
Mhm.
vintages, I can't speak today, were huge. There was a ton of transactions occurring. The
Yeah, look at
worst
here.
vintage,
Oh, 05, 06, worst vintages.
the worst one for us, 2023, is the tiniest.
Yeah, it's less than 4
Yeah.
million or whatever it is. Yeah. Yeah.
Okay.
Yeah. So there's a lot in this that just is like, I wish people would go back in time and really housing moves slower, right? There's switching costs, there's shrinkflation, all of this stuff you bring up in Resi Club. I just got to highlight for folks with Resi Club. Hey, if you're not getting the free stuff, I seriously don't know what you're doing. But if you have a buy box, if you're following what I talk about, like Fresno or Vegas or whatever your buy box is, and you're not getting the historical access to what Lance provides, I really don't know what you're doing. You have what, 400 or 800 markets or whatever it is, just some gargantuan repository of data. Tell people what you have available.
Now, let me show real quick. So I do county and metro mostly.
Okay.
I do have zip code data, but zip code data can be a little crazy.
Wonky. Yeah, because it's some
This
the
is
numbers.
this compares markets in January for active listings versus 2019.
Okay.
And what we know is that when markets have soared up to pre-pandemic inventory levels, we've seen some greater weakness in the market, right? And the reason being is inventory is a proxy for supply and demand. And so if you see a sudden move in one direction, it suggests what's happening in the market. So a great example is Clark County,
Mhm.
where in 2022, the second half, inventory shot up really fast,
Exploded. Yep.
moved up really fast. And there was price weakening,
Yep.
especially in some of these areas that had a lot of the iBuying and stuff like that.
You
And
got it.
they were essentially a temporary forced buyer. But active listings now are back down to 44% below pre-pandemic levels. And we've seen things tighten up in that
And
market.
I don't know if you heard my daily financial news, but Ryan Lebo put out some numbers for February. Talk about most recent. We're talking February.
That's why I brought up Clark. Yeah,
Oh
because
my
Clark
God, it's
is an
ugly.
interesting example where it was one of the markets in 2022 affected more by the shock, mortgage rate
Yep.
shock, and then
Yep.
last year tightened up really quickly. Phoenix is exactly like Las
Hmm.
Vegas. They're pretty much sister cities at this point.
Correct.
Um, let me. I lost. There. Am I still sharing?
No, you're not sharing anymore. At least I'm not
Okay.
seeing it shared.
Give me a second. Um, And so I also do year over year as well. So inventory over the past year has moved up a bit,
Yeah. Look at that.
about 10%. We haven't seen prices necessarily move the same way. But in the West Coast, you've seen a great deal of tightening. I mean, look, Clark County year over year is down 42%. They
Wow.
went to pre-pandemic levels and then they shot back down.
That's
It was
crazy.
wild how fast they tightened. In Boise area, they've started to tighten a lot too.
Look at
Um,
that.
a pocket of weakness to watch is
Florida.
this pocket of Florida. Yeah, the Southwest from Tampa down to like Naples area. And it's
Yeah.
really this Cape Coral. And what happened there is they got hit by that hurricane
Yeah, they
uh,
did.
back at the end of 2022. And they're also getting hit by some pretty big insurance shocks. And so what I try to do for Resi Club is I have trackers for prices and for inventory, days on market, new listings, active listings, all that stuff. For metros, 800, and then 3,000 counties across the US, and I update it monthly.
Folks, again, if you're following what I do at one rental at a time, you have a buy box, you're doing your daily discipline, and you know where you're going to be buy, or if you're not even sure and you don't have access to this, you're 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 flying blind, right? You're looking at actives, you're understanding what's going on, but if you don't have the historical context, I want to remind folks, I went to a meetup in 2006. Olivia and I owned 8 homes at this point. A gentleman named Bruce Norris talked about the California crash. And that was ludicrous to think about because everything was up and to the right. He introduced this concept called affordability. Never heard of it, never thought about it. It changed my life. I realized after looking at historical information, which I had to go to Fresno County for, which Lance gives you in Resi Club Pro, I realized how extreme pricing was. And that one review had me sell all 8 homes within the next 4 to 5 months. It saved my investing career. I took action because of data. And if you're not getting it from Lance, I don't know where you're going to get it from. It's the most historic. It's the most complete. It's updated by someone who's in the housing house. I don't know what you're doing. It's how much is Resi
And
Club Pro?
Well, so it's $299 a year, but I will run deals throughout the year every once in a while around a holiday or something like that for a discount. But $299 a year, and what it comes with is access to my trackers, and then 3 additional articles every week, looking at things happening in the housing market.
For $300, it could save your financial future. And again, it's like a shortcut. If you can go back and look at your buy, like this is what I would tell you to do with this. I would look at your buy box, your city in 2000. I would look at it in 2004, 2008, 2012, because you will see completely different behaviors. You're not going to get this data anywhere else. You'll be able to compare and contrast inventory levels, price. It's second to none source. Go get it. Lance, closing thoughts?
Yeah, the one other thing there is too is the fact that sometimes you will have a market that does a head fake one way or
Yeah,
the other.
sure.
And I think this is a great data set where you can start to see that shift. So Las Vegas is a great example of that, where in 2022, for 3, 4, 5 months, inventory skyrocketed. Things
Yep.
didn't sell, the market just got glued up, and active listings went way up. But what happened is within a few months, it was shifting the other way. But the headlines were still reporting the year over years that had already happened. So the
Yeah.
market had shifted, but the data and especially the year over years had not. And so I
Right.
think a tracker like this, where you can get down to the monthly prints, you can kind of really see that trajectory. And whereas Austin was the opposite, where it had seen the same thing as Las Vegas, but it didn't see the improvement. And then once the seasonally weak period time of the year came, prices fell further.
Yeah, the thing I'm going to be looking forward to seeing Resi Club put out are February actuals, and obviously we're weeks away from there. But uh, I'm hearing from more and more agents just how nutty pendings are in January, which probably means February closings. Yeah, buckle up, Buttercup. It's going to get interesting.
Yeah, there's not a ton of actives in the market, and the market has absorbed more of the mortgage rate shock, I think is important. But I think it all varies by market, especially depending on where actives are in the market. But especially watching the low inventory markets on the West Coast and some of these low inventory markets in parts of the Midwest and Northeast.
Yeah, at
In
the
terms
end of the day, folks, get inside the numbers, see what's going on. Again, I will continue to look at my two markets and the national. You should be looking at your market. You should be using Resi Club. And again, remember the whole point of this picture is real estate doesn't move like crypto. It doesn't move like stocks. It is a lot slower. There's a lot of complex mechanisms. Don't believe don't believe renters or failed mortgage brokers when they're talking about home prices because they don't understand what's going on. Lance, you're amazing. Thank you for coming back each week.
Thank you so much.